Good morning, everybody. My name is Phil Hartley, and welcome to our post-budget summary following the Chancellor's statement on Wednesday. Just a little bit of housekeeping first. If you're unable to hear anything via the computer audio, the details for accessing via the telephone are on screen now. Apologies if there's any technology issues. We should be getting dab hands at this by now, but if there is, I apologise about that. A bit about myself. I'm one of the corporate tax managers at Mitchell Charlesworth. My experience is in advising companies on all corporation tax matters, group restructuring, specialist in R&D tax relief as well. So happy you probably got the right person given the Chancellor's announcements on Wednesday. Feel free to ask any questions during the webinar via the chat function on the GoToWebinar application. I'll answer as much of those as I can at the end, and if I don't answer your question, I will contact you after the webinar to answer that question. You can also contact me direct after the webinar. My email address is up on screen now, and it will be on screen at the end of the webinar as well. The session is being recorded, and then the slides will be circulated after the webinar, so you've got a record of those as well. So the agenda for today, it was quite a beefy budget in respect of two particular areas. We've got the continuing of COVID-19 support, and I'm going to go into a bit of detail about the extension to the job retention scheme, the fourth and fifth grants for the self-employed income support scheme, the extensions to the SDLT reduced thresholds and the VAT rate reductions for hospitality, and some of the other notable support announcements that were made during the budget speech and through the announcements post-budget. I'm then going to move on to the tax changes and what I would call as businesses being targeted first. So we've got the change in corporation tax rate, the loss relief carryback extension, the super deduction on capital spend, which has garnered a lot of press attention, the R&D tax relief changes and upcoming changes potentially coming into place, and the freeze on the tax thresholds across the board up until April 2026. I'm also going to mention a little bit about IR35 and its incoming on the 1st of April 2021. A little bit about free ports, not mega amounts at this stage because we're still waiting for a bit of information from the government on that, but important given that Liverpool City region was mentioned as one of the free ports in England, and then just an overall summary. So we'll start off with the continuing COVID-19 support. And the job retention scheme, it was announced, is going to be extended to the 30th of September 2021. Good news for businesses, in my opinion. It provides certainty that that scheme is going to be in place, and also acknowledges that although lockdown restrictions are meant to end on the 21st of June, it's not going to necessarily be all back to normal straight away on the 21st of June. It may take a little bit of time for certain businesses to get back into the swing of things and need a full workforce in place. The scheme is going to remain as it is currently until the 30th of June 2021. So that's 80% of the salary up to £2,500 per month. From July 2021, employer contributions will then come into play. So that's starting at 10% for July 2021 and then rising to 20% for August and September 2021. As has been the case previously, it's only available on hours that are not worked. So it's going back to more like the flexible furlough scheme that we had around about the same time, July 2020, when that came into force. The self-employed income support scheme. Now, the headline act was that it's the fourth and fifth grants have been announced for the self-employed, but it's not as it seems. It's slightly going to be different in how that is potentially calculated, particularly the fifth grant. So the fourth grant is available from late April to the 31st of May 2021, and that's so that HMRC can process all the self-assessment tax returns that have been submitted for the 19-20 tax year, and it in theory allows up to 600,000 self-employed individuals who missed out on the earlier grants to be able to claim this grant. Important point to note there that if you've not submitted your self-assessment tax return, you are now too late to be able to claim the fourth grant. That had to be submitted by midnight on the 2nd of March. The grant for the fourth grant is going to be the same. It's going to be 80% of the 3 months average trading profits up to a maximum of £7,500. But the barometer to determine what the average trading profits will now be based on the 19-20 tax return, not the 18-19 tax return as has previously been the case. The fifth grant is going to cover the period the 1st of June 2021 to the 30th of September 2021. And the calculation for that grant is going to be different. It's all going to be based on a turnover reduction. And in particular, if the turnover is reduced by more than 30% in the period to April 2020 to April 2021. If that's the case, then you will receive the same level of grant as you will obtain under the fourth grant, being 80% of the 3 months average trading profits up to a maximum of £7,500. If the turnover reduction is less than 30%, then you receive much less of a grant. You'll receive 30% of the 3 months average trading profits up to a maximum of £2,850. At this stage, we're unclear as to what supporting documentation is going to be required. It's not necessarily just going to be your personal tax return needs to be submitted earlier, because year ends may be different based on each sole trader, each partnership. We will provide more information as and when we get it as to what supporting details will be required. And unfortunately, we're just in the hands of HMRC until that information is provided. As expected, the stamp duty, land tax reduced thresholds and the reduced VAT rate for the hospitality, holiday, accommodation, attractions was extended. But actually, in my view, it was extended a bit further than was announced or in the press previously. So the SDLT reduced threshold, that's going to remain at £500,000 until the 30th of June 2021. But then it reduces to £250,000 until the 30th of September 2021. And then from the 1st of October, it's back to its normal level of £125,000. In my view, that seems to be sensible planning from the Chancellor. We were going to avoid a cliff edge where the property market could nosedive straight after the 30th of June, given that it would have gone from 500,000 to 125,000. So he's trying to stop that from happening with a halfway house for 3 months after the 30th of June, just to allow any of the smaller property purchases to benefit still until that date. We've then got the 5% reduced VAT rate for hospitality in place to the 30th of September 2021. But then that rate's going to increase to 12.5% until the 31st of March 2022. And then we're back to normal at 20% on the 1st of April 2022. Again, a bit trying to help businesses in that sense, not a cliff edge moment where we go from 5% to 20%. It's a 50% increase to 12.5%, and then another 50% increase to 20% on the 31st of March 2022. Just some of the other notable support announcements. There's a lack of detail on some of these, so these are just the headline grabbers, and we'll provide more details as and when the government announces details on these. So we've got the Restart Grant Scheme. So this is a grant that's going to be payable to businesses of either up to £6,000 or £18,000. And this seems to depend on the industry that you're operating in and when the restrictions for your trade are lifted. So for example, the up to £6,000 grant will be for trades that are restricted till the 12th of April, is what the Chancellor said in this announcement. And the £18,000 up to will be on restrictions that are for further in the future. We've got the Recovery Loan Scheme. So this is going to replace the CBILS and the bounce back loans, which end on the 31st of March. And on the 6th of April, we'll then have the Recovery Loan Scheme. And the headline announcement there is that loans between £25,001 and £10 million, or asset and invoice financing between £1,000 and £10 million, will come with a government guarantee of 80%. And the government has said that quite a lot of the banks are on board with this. Again, we'll have more information for you as and when more details are announced. The extension of the 100% business rates relief to the 30th of June 2021. And then a 66% reduction thereafter to the 31st of March 2022. So in effect, for the 2021-22 tax year, we've got a net 75% reduction in business rates. Again, an important lifeline for businesses currently, but also showing that it will eventually come to an end in the future. We've got the new mortgage guarantee scheme from April 2021. So that's a return to 5% deposits that David Cameron and George Osborne had as a policy a few years ago. Again, not a lot of detail on that as of yet, but seems to be the main banks are signing up for this scheme. and will ultimately help first-time buyers or by generation rent to become generation buy. And a final point, there was a lot of incentives announced for hiring apprentices. Again, waiting for some more details as to how that works. But the one bit that we can tell you now is that the cash incentive to hire apprentices is going to double from £1,500 to £3,000 per hire of apprentice. So moving on to the tax changes, and as I said at the beginning, it seems that his tax changes were mainly focused towards businesses, which kind of fits in with what a lot of the thinking was before the budget announcement, because it's businesses that have had a lot of the relief throughout the pandemic. So the main headline grabbers, the change in corporation tax rate. From the 1st of April 2023, profits over 250,000, the rate is going to change to 25%, up 6% from 19% that we've currently got. I was quite shocked at that, to be honest. I thought it was going to come in over the period of the Parliament and eventually get to that sort of level. But he has just said, no, 25% from the 1st of April 2023. A few caveats to that. We've got profits under £50,000, which the Chancellor believes is 70% of businesses in the UK. Their rate will be 19% and will stay at the same level. And unfortunately for tax advisors, we've gone back to the rules of marginal rate relief between £50,000 and £250,000. It's important to know that that isn't going to work as it does with personal tax. So if your profits are under 50,000, you'll be 19%. But as soon as you go over 50,000 profits, then all the profits will be at the marginal rate of tax. And as soon as you go over 250,000, all the profits will be at 25%. Devil's in the detail with a lot of these tax announcements, and one of the things that is going to change is that to determine the thresholds for example, for quarterly instalment payments, and now the thresholds for these tax rates, we had rules called 51% group companies. So if you were part of a group and that you had trading entities within that group, the number of trading entities in the group reduced the thresholds. So as an example, say we had a group with 3 trading companies, the thresholds for the quarterly instalments were reduced from 1.5 million to £500,000. And actually now what's going to happen is we're going backwards in terms of legislation, and we're going to associated company rules. So you'll still have all your group companies, but if you have a director shareholder who has 3 separate businesses in his own right, they will also come into the mix for determining the levels of quips and the thresholds for tax. So as an example, let's say we had 5 associated companies, then actually the profits need to be only over £50,000 for the 25% tax rate to come into play. So again, it's just something to be wary of, something to be mindful of. We'll be finding more information and advising our clients on this matter as and when it comes around and how that can impact yourselves. Another little element to this in the detail that was announced post-budget is that closely held investment companies, regardless of level of profit, will be taxed at 25%. So that really impacts on family investment companies in particular. They're going to be charged at 25% on their profits, regardless of the levels of profit that they have. Just a few other points that I've mentioned about, well, this will have a knock-on effect for salary, dividend, remuneration planning. And by that, I mean that when we're looking at that, we tend to do a calculation that shows what's the cost to the company of taking a salary from the business, and what's the tax benefit if actually we take a salary and dividend option, but keep the same cost to the company. I've done some quick calculations that I'm going to back up in more detail, and the gap is going to reduce quite significantly, depending on level of income, as between what the cost of the company is and how much extra income you get as a result of a salary and dividend strategy. But we again will provide some more details of that in due course. And I think another point to mention here is actually the increase in tax rate really brings into focus planning with the tax reliefs that are available. I'm going to go into a bit more detail about R&D tax relief in a few moments' time, but patent box tax relief, pension contributions from the company, all these things will end up providing a bigger tax relief when we hit these 25% rates of tax. And it's something to definitely consider and to start thinking about now, so that when we get to the 1st of April 2023, you're in a position where you're already in the cycle of making R&D claims, for example, or making pension contributions from the company, and therefore reducing your tax position accordingly. We've got the loss relief carryback extension. So this is going back towards when we had in the recession, where we could carry back a loss that's been incurred for corporation tax trading profits and also for income tax trading profits from not just 12 months, but now to 3 years. So as an example, for March 2021 year end, we can carry that loss back to profits potentially incurred in the March 2018 year end and receive a corporation tax refund. For corporation tax, this loss relief carryback extension applies for periods ending between the 1st of April 2020 and the 31st of March 2022. That's quite important because I know for ourselves, we've submitted returns to HMRC already where the year end has been past the 1st of April 2020. And it may mean we just need to have a look at it. I know I'm speaking to the team in-house to see if we got any of those sorts of cases and do we need to have a review of if we can carry any losses back further than we already have done, for example. For income tax, it's a bit more straightforward. You've got, it applies to the 2020-21 tax year and the 21-22 tax year, and it's restricted to trading income only. Important bit of planning that needs to be considered with this loss relief carryback extension. For companies that need the cash, it's a fantastic way of being able to get some tax refunds from HMRC that wasn't anticipated. But you've got to bear that in mind with actually, if you don't need the cash or you're a cash-rich company, you may want to think, actually, I'm going to keep those losses and utilize them when the tax rate goes up to 25%. So it's not a case of let's just carry them back. I think the advice here is let's think about it, think about the long-term position of the company. If the cash isn't as necessary as required, then you may want to think of carrying forward those losses to obtain more tax relief in the future. Again, we're happy to have those conversations with you as and when they arise, just to make sure we're getting as much tax relief as we possibly can. So the super deduction on capital spend, this was his unexpected rabbit out the hat announcement in the budget. This hadn't been talked about at all prior to the budget. And it's quite an innovative tax relief that's been provided, really. The headline act is that it's a 130% deduction available on spend on capital assets. But what actually capital assets mean, it's a spend on new and unused plant and machinery. And this relief is going to be available between the 1st of April 2021 and the 31st of March 2023. And the 130% deduction is available for items that will qualify for the main pool of the capital allowances treatment. So again, with all these sorts of things, it's devil's in the detail. And actually that one, it's not as straightforward as if you buy a house, for example, or you invest in a company, you're going to get this relief. It's narrowed down to spend on new and unused plant and machinery. So no, you can't buy a second-hand plant and machinery and get this deduction. And equally, there's further restrictions in place if you're buying a leased asset. You have to meet certain requirements to be able to claim this deduction. If the spend only qualifies for relief under the special rate capital allowances treatment, then the deduction is only 50%. So that's quite a significant reduction. And it's only available to companies. Sole traders will continue to receive annual investment allowance, but they cannot claim this 130% deduction. We are waiting for a little bit more detail. It is getting announced in dribs and drabs. We have some draft legislation, and I think a key point that I've come across just this morning, advising one of our clients who's thinking of making quite a significant spend on an asset, is that where you have a period that straddles the 31st of March 2023, that 130% deduction is actually reduced even further. And so, for example, in my instance, it's a December year end, and actually the deduction is only going to be 107.4% in the year ended the 31st of December 2023. So the key takeaway really is planning when you're going to incur this expenditure. If you've got to make a big purchase and it can wait till after the 1st of April 2021, our advice would be to do so. The relief doesn't apply if you've already entered in a contract before the 3rd of March, but if the spend is after the 1st of April 2021 and the contract was entered into after the 3rd of March, my opinion at the moment is that would qualify. But then it's important further down the line, if you've got a year end that isn't the 31st of March 2023, the actual relief in that last period is going to be less. And it may well be that actually it's better making that spend earlier if possible, obviously taking into account commercial decisions, to maximize the tax benefit that you're going to receive. The client that I've been dealing with, it's a difference of about £25,000. So it's not an insignificant amount of money, and it's something that needs to be considered in more detail. So R&D tax relief. He didn't actually make a formal announcement in the budget on this, but again, devil's in the detail, and post-budget, there was a couple of things announced in this regard. And we've got confirmation that the pay-as-you-earn cap is going to be introduced from the 1st of April 2021. I've had a few clients over the past couple of days concerned about this cap, wondering what the impact is on R&D claims in the future. And actually, the pay-as-you-earn cap being introduced is only really to impact a small number of R&D claims. And the cap is in relation to the payable credit. So when an SME makes a loss and exchanges that loss for the cash credit, it's in relation to that. And it's restricted to £20,000 plus 3 times pay-as-you-earn liability of the company. So it doesn't impact a company that's got high profits and reducing those profits, and therefore either getting a tax refund or a tax saving. It doesn't impact a company who is making a loss but has quite a large pay-as-you-earn liability, or has a pay-as-you-earn liability, because they can times that by 3 and still receive the payable credit. It is only impacting potentially startups where they don't have any pay-as-you-earn liability and are relying on using third parties. But the main aim of the policy is to stop fraudulent claims. HMRC were getting claims with no pay-as-you-earn liabilities, or companies with no pay-as-you-earn liabilities claiming huge sums on subcontractor spend, for example, and then claiming the credit, and then they would be around the next day, taking that money out, etc. It is deemed to try and stop fraudulent claims, and there's been a lot of consultations with professionals on this matter to make sure it is as little damage to startups as possible. Also announced was a review into R&D tax relief, and this review is in, as per the review document says, is to keep the tax relief remaining competitive in the world as a whole. That's a positive, in my opinion. It just continues to reaffirm that HMRC and the government's key is to continue to promote R&D tax relief and allow this to be claimed by companies. But again, devil's in the detail with this sort of stuff. And the review document goes into quite a few questions about cracking down on fraudulent claims, cracking down on the unregulated nature of the industry as a whole, and possible future changes to the SME scheme. So that includes changes to what qualifies as R&D spend, and also potentially aligning both the RDEC scheme, which is for large companies, and the SME scheme together. So we've got one scheme that is claimed by all, with a potential higher rate for the SMEs. And this consultation document is open until June 2021. So we're not going to get any announcements anytime soon. The earliest is possibly in the autumn when we have a budget then, or this time next year if we're having that is the next budget. So we'll be keeping a firm eye on the developments here and advising clients of any implications as a result of this review. The freeze of tax thresholds. So we have income tax personal allowance at the moment. That's going to increase from the 6th of April 2021 to £12,570, and the higher rate band is going to increase at the same date to £50,270. But thereafter, it is frozen. It's going to be frozen until April 2026. There will be no increase in that period of time. For income and inheritance tax thresholds, and the annual exemption for capital gains tax at £12,300, they're also going to be frozen over the same period. And over the same period for the pension lifetime allowance, that's frozen at £1,073,100. The VAT registration and deregistration thresholds are frozen at £85,000 and £83,000 from the 1st of April 2022, but that's only for 2 years as it stands. This is known in the world of tax as a stealth tax. It's meeting the government's pledge not to increase the rates of income tax, national insurance, and VAT, but it does result in higher tax bills in the future as wages and income rise. So the government is anticipating receiving I read around £10 billion as a result of this measure. So it isn't an insignificant measure, but it does meet the government's pledge not to increase tax rates. So take that as what you will, but in the future, as your income rises, you are likely to be paying more income tax than you would have done if this freeze wasn't in place. Just a little bit now on IR35, and although again not mentioned directly in the budget, there was some further clarification documents submitted after the budget, which in effect confirms that from April 2021, IR35 for the private sector is definitely coming into place. There will be a soft landing in relation to this, so penalties for incorrect reporting up until April 2022 won't be in place, and won't be applied until April 2022. But in my view, you do need to be careful, and you need to be considering the position of contractors that you're utilising. If you are deemed to be a company that has to report under this threshold, and that is a turnover of over £10.2 million, as for the group as a whole, you really need to be considering, are my contractors under the right relationship? Should they be deemed employees, and vice versa for contractors, understanding what does this mean for me, and how do I demonstrate that I'm potentially not caught by these rules, or if I'm caught by these rules, what are the tax implications accordingly? HMRC have also confirmed that if you are deemed to be employed from April 2021, this won't impact earlier years of being treated not under IR35, and they won't look into it unless there's fraudulent activity as a result. So hopefully that gives a bit of saving grace, that you're not going to have a knock on the door earlier where you felt that you've abided by the rules and treated yourself in the correct way, but now it's changed because the private sector company has decided that you should be a deemed employee. And just a little bit about Freeports. Freeports, there's not a lot of information out there at the minute, but I felt it's definitely worth mentioning, given that Liverpool City region has been classed as one of the 8 Freeports that will be in place in England. A little bit of information announced on budget, released on budget day. There are certain tax benefits in relation to this. There's some stamp duty, land tax exemptions on the purchase of commercial properties in the Freeport area, and there's some enhanced capital allowances within the region. The enhanced capital allowances are 100% first year allowances on any plant and machinery purchased when you're in a Freeport area, and also there's a 10% relief for structures and buildings allowance, where currently that's at 3% for any other company outside of a Freeport's area. Again, there's going to be more detail to require from the government on here before we can advise further, but rest assured we'll be on top of that and providing any further information about Freeport status in due course. So just a bit of a summary really from myself on the budget as a whole. The lack of announcements on changes to capital gains tax, business asset disposal relief, which is what was entrepreneurs relief, inheritance tax, and the lack of immediate tax rises meant that this budget wasn't really as sweeping on tax reform as many feared. It could have been a lot worse, but given that we're still in a pandemic area right now, I think he couldn't go that far and risk further damaging the economy. As I said earlier, I was quite shocked that the corporation tax rise has been implemented so quickly, being that it's all in place by the 1st of April 2023, and particularly given that we're in a post-Brexit and pandemic environment. Ultimately, the companies that are going to be paying that 25% rate are the ones that are employing the people and helping drive the recovery on the economy. Now, we're still, by all effects, going to be still the lowest G7 nation corporation tax rate, and so that still helps us in that respect, but it is a bold move in my opinion, and hopefully one that won't backfire on the Chancellor. However, the lack of announcements on budget day doesn't mean that these announcements aren't coming, and we actually have something that in the tax world we call Tax Day on the 23rd of March, where a lot of policies and consultations all get released on this one day. And we've got a particular documentation that's being released called Tax Policies and Consultations Spring 2021. And it's envisaged in this document that that's going to set out what the Chancellor wants to do in the future with, for example, capital gains tax, inheritance tax, tax rates generally, etc., etc. So for me, although this budget wasn't as sweeping on tax reform as we thought it could be, I think the changes are coming, and we will know more on the 23rd of March, the future changes that are coming that could be as early as autumn 2021 or spring 2022, depending on when he has his next budget. So if anybody has any questions, I'll be delighted to answer those questions for you now. I think I've got one through already, saying, is the spend on plant and machinery include the device or machine we bought from UK or other countries or not? So I think what you might be meaning there is, does it have to be purchased from the UK, or can it be purchased from, for example, Germany, America, wherever it may well be? From the legislation doesn't dictate it has to be in the UK, and it just dictates in a minute that it has to be new and or unused machinery. And so it can't be a second-hand machine. It has to be new and unused, and it can't really be a hire purchase or leased asset as well. If it is, there's certain criteria that you've got to meet. I don't think at this stage that there's a restriction on if it's bought in the UK or not. I think it's a case of you will have it, you'll get it if you buy it new or unused. Just waiting to see if there's any more questions to come through. I think from my perspective, I think I said it earlier, but I think the important point to take away from this is that, okay, the rate of corporation tax is going to increase, but I think it's an opportunity as well to go, well, do we qualify for R&D tax relief, for example? If I've got a patent, am I claiming patent box tax relief? And am I making the pension contributions from the company that I can do just to maximise the tax relief I can get from that? And it's important to consider that as soon as possible, in my view, so that you're in a process where you can go, actually, we know we can claim this, we know certain activities we're doing are qualifying, we know we're maximising our pensions where we possibly can. And therefore, we are in a position when we come to April 2023 that tax increase isn't going to be as significant on you as it possibly could be. Just a few other questions that have come through. Is the super deduction just for limited companies or sole traders? It's just for companies, and it specifically says that in the legislation. It is just for companies. Sole traders will not qualify for the super deduction, but they will be able to claim annual investment allowance still. The next question was, how likely do we think the Amazon tax will come in later budgets? It's a good question, because a lot of talk before the budget was that we were going to have a parcel tax. I think the government has still got an agenda of trying to regenerate the high street. So my view would possibly there is going to be some sort of tax in that area in the future. It was noticeably quiet on like a digital sales tax, for example. I think come the 23rd of March, we might be in a bit of a clearer position as to what he intends to do in that area. And again, we'll provide that information as and when we've been able to digest it. Just another question here. How will purchases with grant support be treated in terms of the super deduction on capital spend? Really good question. And actually, it's an area in particular that hasn't been covered in the legislation as of yet. Normally, you don't get capital allowances when it's covered, or you offset your capital allowances from the amount you receive from grant funding. And I can't see why that wouldn't still be the case. I can't see why you could get a grant and also get this super deduction. But we will be probably waiting for clarification from HMRC on that treatment. And again, let me know who you are on that one to see if we can help you once we've got that further information. Another question through, did the budget contain any comments on the deadlines for making tax digital implementation? It didn't. It confirmed that the changes are happening from the 1st of April 2022 for making tax digital for VAT. So that everybody in effect is covered by that point. And we have been told already that making tax digital for income tax is anticipated to come in March 2023, and for corporation tax from March 2026. Other than that, not a lot of further details on that front at the moment. Another question, are takeaways covered by the continuing reduction in chargeable VAT from 20% to 5%? I am going to pass the buck on that one, unfortunately. I'm going to ask you to get in touch with my colleague, Alison Birch. She's our VAT partner. She will be able to answer that question a lot easier than me trying to find an answer for you now, which may be incorrect. So we've got your details, whoever asked that question, and therefore I'll pass that to Alison Birch and ask her to respond to you. Another question, is there any additional benefit available under the budget to capital equipment bought during 2020-21 tax year, i.e. already bought and delivered before the budget? The only benefit as such is that annual investment allowance, it was confirmed, would be increased. So we were meant to decrease our annual investment allowance from £1 million to £200,000 from the 31st of December 2020. Prior to the budget in January time, it was confirmed that the annual investment allowance will remain at £1 million until the 31st of December 2021 at the minute. And there's been a lot of representations from the CIOT and the ATT, for example, saying we need more certainty on AIA. We need to know how that impacts with the super deduction. So in that respect, if you spent under £1 million, you will still get 100% relief on the purchase that you've made. You just won't be entitled to the additional 30%, unfortunately. Can we claim the new machines deduction from you? Yeah, so in effect, it goes on your corporation tax return. So we will, when we are preparing your corporation tax returns for whichever year end you make the purchase, potentially, we will pick that up on the corporation tax return and ensure that the treatment is correct and we're claiming the super deduction where possible. And I think I'll just give it one more moment to see if there's any other questions coming through. But I think that may well, oh no, one more. Are furlough payments received by companies from government to be treated as taxable income? In short, yes. It is taxable, and you will then pay corporation tax on that income. And so it'll be included in the calculation to determine what the corporation tax profits are. A notable point to mention really though is that actually for a tax geek like myself, the corporation tax return is changing from the 1st of April. And we have to show what companies have claimed under the furlough scheme separately. So we have to show how much has been claimed, and we have to also tell HMRC how much we expected the company to claim. And now in most circumstances, that will be the same figure and that'll be fine, but it's a way of HMRC being able to recoup from companies that have overclaimed in the past and haven't yet told HMRC. So it's just something to be bearing in mind. We've been speaking to the accounts and audits team recently to say this is a requirement that we have and we have to collect the information accordingly. And if you claim the right amount, it's not an issue. We just have to show it separately on the corporation tax return. And I think that is everybody. So thank you very much for your time today. I hope you found the session informative. My details are on screen now. You can email me directly if you have any questions, or feel free to get in touch with any member of the tax team, and we'll be more than happy to help you. And look forward to hearing from you in the future. Thank you very much.